Have you heard people talking about ETFs, but wondered what they actually are or why they've become one of the most popular investment choices today? Could they be the game changer your portfolio needs? ETFs, which stand for exchange-traded funds, have become very famous very quickly over the past few years. In fact, more than $6 trillion have been put into the global exchange-traded fund, ETF, business right now. The exchange-traded fund, ETF, market is getting a lot of money from investors all over the world. There's no question that something amazing is happening here. To be honest, I started investing in exchange-traded funds, ETFs, a few years ago, after I learned everything I needed to know about them. Around that time, I had put money into index funds and investment funds. A lot of people have asked me questions about exchange-traded funds, ETFs. That's why I made this lesson to help you. What are ETFs? Exchange-traded funds, ETFs. What are they? As the name suggests, an exchange-traded fund, ETF, is a type of investment vehicle that trades on a stock market. Many investors can share their money and get the benefits of having a professional investment manager watch over their portfolios with exchange-traded funds, ETFs. It's important to remember that most exchange-traded funds, ETFs, are passively managed. This means that the portfolio manager doesn't choose which investments to buy or sell based on their own preferences. Instead, they use a method based on rules to make sure that you are exposed to a wide range of investments. Come on, look at this picture. Let's say you want to invest in the tech industry because you believe in the huge potential of companies like Apple, AAPL, and Microsoft, MSFT. If you put your money into an actively managed investment fund, the portfolio manager would put in a lot of work to find the best tech assets. An inactive fund makes the difference. If the people in charge of a passive fund had to choose between two choices, they would either invest in all tech companies or pick specific companies based on a certain set of rules. Why do so many people use exchange-traded funds, ETFs? ETFs, or exchange-traded funds, are not always the best way to invest. Their only change was to make the investment fund able to be traded on a stock market, which was a small change to an already existing idea. But why do so many people use exchange-traded funds, ETFs? ETFs, or exchange-traded funds, have two main advantages over mutual funds, which are, in addition, they offer cash during the day. The fees they charge are usually lower. Allow me to talk more deeply about each of these things. When you buy or sell an exchange-traded fund, ETF, you have access to intraday trading. You can sell the exchange-traded fund, ETF, whenever you want during the business day. Even though this seems like a trait that should be obvious, investment funds have not always behaved in this way. In general, mutual funds have once-a-day liquidity. This means that the price at the end of the business day will determine how the investment fund is sold. Even worse is the situation with hedge funds and other non-traditional ways to trade. A lot of hedge funds have refund plans that are either monthly or quarterly. This means that you can only get your money out at certain times of the year. Also, they often have lockup periods, which mean that you have to keep your money saved with them for a certain amount of time before you can take it out of your account. These problems are solved by the short-term liquidity that exchange-traded funds, ETFs, provide. But this immediate liquidity does cost something. Unfortunately, investors can make bad choices about their investments when momentary liquidity is used in the wrong way. This can be anything from selling an exchange-traded fund, ETF, when it loses a small amount of money to day trading leveraged ETFs, which is a very strange thing to do. Even though immediate liquidity gives investors the freedom to sell their investments whenever they want, they can still make big emotional choices that hurt their portfolios. The second reason exchange-traded funds, ETFs, have become so famous is that they don't cost much. The difference is really strange. Morningstar data shows that the average fee for a Canadian equity mutual fund is 2.35%, while the average fee for the top 100 Canadian exchange-traded funds is 0.31%, with fees ranging from 0.5% to 1.29% for each fund. These fees have costs attached to them. They are often called the management expense ratio, MER. You would have to pay $142 in fees to own the mutual fund, but only $53 to buy the exchange-traded fund. This is based on a $10,000 account. The numbers get even scarier as the size of the fund grows. If you had a portfolio of investments worth $500,000 and used the usual fee structure mentioned above, it would cost you $7,100 to buy the mutual fund. However, you would only have to pay $2,650 to buy the fund. The real question is why exchange-traded funds, ETFs, are so much cheaper than mutual funds. To begin with, they have a lot less management costs. Part of the reason for this is that ETFs are basically just ignored. Passively managed exchange-traded funds, ETFs, don't have to pay for a group of study analysts who decide which stocks or other assets to invest in. Actively managed funds, on the other hand, have to pay for these analysts. In general, the assets that are managed have grown a lot thanks to exchange-traded funds, ETFs, and their better fee structures and liquidity. This trend is talked about in more depth in the next part of this piece. What are the steps to buy exchange-traded funds? Now that you know what exchange-traded funds, ETFs, can do for you, you probably want to know how to invest in them. Before you can do anything else, you will need to open an account with one of the big brokerage companies. There are no fees to buy exchange-traded funds, ETFs, on Questrade, making it the best place to do so in Canada. What this means is that you can buy exchange-traded funds, ETFs, without having to pay any buying fees. Many people, on the other hand, start an account with a discount brokerage that is linked to their bank. Some of these are TD Direct Investing and BMO InvestorLine. You have more options when you're in the United States. Exchange-traded funds, ETFs, can be bought for free through a number of trading firms, including Interactive Brokers, Charles Schwab, and TD Ameritrade. Websites like etfdb.com make it easy to find exchange-traded funds, ETFs, that meet your financial needs. If you don't want to do your own study on your exchange-traded funds, ETFs, you can always follow a model portfolio. Not only that, but robo-planners such as JustWealth, Wealthsimple, and RBC Investees can also help you buy exchange-traded funds, ETFs. But on top of the ETF management fees, MERs, these robo-advisors will charge you an extra fee. Doing it this way costs more than doing it yourself, but it costs less than putting money into mutual funds. How to keep your exchange-traded funds assets in good shape. Do-it-yourself investors often use spreadsheets to help them keep track of their returns and figure out deals when they rebalance their portfolios or spend more money. A simple Google search for portfolio management spreadsheets will bring up a number of models that you can use or change to fit your needs. If you don't want to spend time playing around with numbers and spreadsheets, you might want to use a portfolio management tool like Passive. Your brokerage account and Passive work together to handle your portfolio for you, so you can focus on other things. You will be able to understand investing better and save a lot of time if you do it yourself. When Passive is used, the brokerage accounts of thousands of do-it-yourself users are turned into their own personalized robo-advisor service. And this is how it works. By signing up for Passive, you can make a free account. You build a goal portfolio after setting up a connection between Passive and your brokerage account. Passive will show you all of the moves you need to make at your broker in order to keep your goal portfolio whole. In addition, it will let you know whenever your stock strays from the goal or whenever extra cash comes in. If you pay more for Passive Elasi, Passive will make the process even easier by letting you place trades with your dealer with just one click. Every Questrade customer in Canada can get Passive Elite for free as part of a special promotion. Passive Elite usually costs $99 a year, but right now there is a deal going on. At the moment, Passive works with Questrade in Canada and Interactive Brokers, TD Ameritrade, and Alpaca in the US. You can also get the integration in Canada. Many people have become more interested in exchange-traded funds, ETFs, over the years because they make it easy to broaden your portfolio while also lowering your costs. Even though exchange-traded funds, ETFs, are easy to get, you should still have a plan to make sure you don't trade too much and lose sight of your long-term goals. Passive is a tool that can help you make your own robo-advisor while keeping the costs low. If you enjoyed learning about ETFs and want more simple, actionable investment tips, don't forget to subscribe to our channel and hit the notification bell. Let's grow your financial knowledge together.